Next is profitability. We have 4 types of ratio. Profitability means that indicate the financial performance of the business in terms of profitability. The first ratio is gross profit margin. The formula is gross profit divided by sales. Next is net profit margin. The formula is net profit divided by sales. Return on assets. Formula is net profit divided by total assets. And return on capital employed, which is EBIT, earning before interest and tax, divided by capital employed. How to get the capital employed? Equity plus with non-current liabilities. Okay, the first ratio is the gross profit margin. The formula is gross profit divided by sales. So in this question, the gross profit is 154,583 divided by sales 509,457. Then we get 0.3034. Normally represent by percentage. Therefore, we multiply by 100. Then we get 30.34%. Which indicate that the firm generate RM 30.34 of gross profit from RM 100 of sales. For net profit margin, the formula is net profit divided by sales. So net profit is 34279 from the statement of profit or loss, and sales is 509,457. And then we get 0.0673 multiplied by 100, then we get 6.73%. The firm generate RM 6.73 of net profit from RM 100 of sales. Next is return on assets. The formula is net profit divided by total assets. So net profit, which is 34279 from the statement of profit or loss, and return net total asset we get from the statement of profit, statement of financial position, which is 386,977. Normally we multiply by 100, so the answer is 8.86%. Which means that the firm generate RM 8.86 of net profit from RM 100 investment of total assets. Next, return on capital employed, ROCE, or return on investment, ROI. The formula is EBIT divided by the capital employed. So EBIT we get from the operating profit here 54050, and the capital employed we get the statement from the statement of financial position, which is equity 183,131, and non-current liability, which is 28694. Then we get the answer 0.2552 in the form of percentage. We multiply by 100, then we get 25.52%. Which means that the firm generates RM 25.52 of operating profit from RM 100 invested in capital employed. Possible causes of profitability problem include high cost of goods sold, high operating expenses, ineffective pricing policy. Suggestion to improve: reduce cost of goods sold, reduce operating expenses, and reduce selling price. Next is market ratio. Market ratio indicate the financial stability and structure. We have 4 types of ratio. The first one is earning per share. The formula is net profit divided by number of ordinary share issued. OS is ordinary share. Next is dividend per share. Dividend, which is ordinary share. Sometimes company they have preference share or preference dividend. So we we only take the figure for dividend ordinary share. Net dividend ordinary share divided by number of ordinary share issued. Next is dividend payout ratio. The formula is dividend per share divided by earning per share. And finally, price to earning ratio, market price, which is per share divided by earning per share. Then we get the PE ratio, price to earning ratio. Additional information, which is market price of ordinary share as at 31st December 2012 was Rm2 per share. Dividend paid for year 2012 is Rm15 million. Number of share outstanding is 150 million at the end of 2012. The first calculation is EPS, which is net profit divided by number of share outstanding, which is 34279 we get from the statement of profit or loss, which is the net profit, divided by 150,000 based on the information number of share outstanding. Then we get EPS is Rm 0.23 per share. Dividend per share based on the additional information, dividend paid is 15 million. Therefore, divide by number of share outstanding 150 million, then we get Rm 0.10 per share. Dividend payout ratio, which is dividend per share divided by earning per share. So dividend per share is 0.10 divided by earning per share is 0.23. Then we get 0.4348, which is in the form of percentage, 43.48%. And finally is PE ratio, which is market share based on the additional information, which is Rm2 per share divided by earning per share, which is 0.23. Then we get 8.6957 or 869.57%. Okay, types of ratio comparison. Basically, there are two types. The first one is trend analysis, which is internal comparison, meaning that comparison of the ratio year by year in a firm. Next is cross-sectional analysis, which is external comparison, which means that comparison among a cross-section of firms, country, entire population, industry average, and etc. Uses and limitations of ratio analysis. The first one is uses. Comparison purposes, which is year by year or industry average, to evaluate current performance, to assess the efficiency of operations. Next is limitations. Comparison with industry average is difficult because we need the information on the industry, and it's quite too difficult to gather all the data. Average performance in industry may not be desirable, definitely, because if you compare with the market leader, which is the company that already established, therefore it's quite difficult for the company to achieve. Seasonal factors, this is effects on the company that have seasonal factors in terms of the market. Then from year to year it will be affected in terms of comparison. Next is inflation due to market or economy. Then it will be effect in terms of comparison year by year. Different accounting and operating practices. For example, in terms of depreciation, we have two options: straight line basis and reducing balance method. So if the company use difference of accounting practice and then you compare with your performance, therefore is not comparable because both method will affect the profit for the company. Next is difficult to conclude the ratio, good or bad. Okay, that's all.